Hello, and welcome back to FX Limit, your go-to channel for all things finance and trading. Today, we're diving into a crucial topic that every serious investor should master, using fundamental analysis to predict interest rate changes and understand their effect on currency values. This is a topic that's not only fascinating, but also immensely practical in the world of currency trading. Let's start with the basics. Fundamental analysis, at its core, involves examining the economic indicators, financial statements, and other qualitative and quantitative factors to assess a currency's intrinsic value. It's like being a financial detective, piecing together different economic clues to forecast future currency movements. Now, one of the key drivers in the Forex market is interest rates set by central banks like the Federal Reserve in the US, the European Central Bank in Europe, and others around the world. Interest rates are like the heartbeat of the financial world. They influence everything from inflation to the value of your currency. So, how do interest rate changes affect currency values? It's quite straightforward. Higher interest rates offer lenders in an economy a higher return relative to other countries. Therefore, higher interest rates attract foreign capital and cause the exchange rate to rise. Conversely, when a country lowers its interest rates, the currency tends to weaken. But here's where it gets interesting. Predicting interest rate changes isn't just about waiting for central bank announcements. As savvy traders, we need to be ahead of the curve. This means analyzing economic indicators that influence central bank decisions. These indicators include inflation rates, employment numbers, GDP growth, and consumer spending data, among others. Inflation is a key indicator. Central banks often raise interest rates to control inflation. If you see signs of rising inflation in an economy, it could be a clue that higher interest rates are on the horizon, which might strengthen the currency. Employment data is also crucial. Strong employment numbers can signal a healthy economy, potentially leading to higher interest rates to prevent overheating. On the other hand, rising unemployment can lead to rate cuts as a means to stimulate economic growth. GDP growth is another significant indicator. A growing economy often leads to higher interest rates, as central banks aim to balance growth with inflation. If the GDP is rising faster than expected, prepare for potential rate hikes. But it's not just about the numbers. Political stability, global events, and market sentiment also play a huge role in currency values. As a fundamental analyst, you should keep an ear to the ground for geopolitical events, policy changes, and even natural disasters that could affect the economy's outlook. Now, let's talk strategy. To successfully use fundamental analysis in currency trading, start by selecting a few key economies to focus on. It's impossible to track every global event, so pick your battles wisely. Once you've chosen your focus economies, delve deep into their economic indicators, central bank statements, and political news. Next, maintain a balanced view. Don't get caught up in a single indicator or news piece. Forex trading is complex, and multiple factors can influence currency values at the same time. Always look at the big picture. And remember, timing is everything in trading. Be patient and wait for clear signals before you make your move. Sometimes, the best trade is the one you don't make. In conclusion, fundamental analysis is a powerful tool in predicting interest rate changes and understanding their impact on currency values. By staying informed, analyzing key indicators, and maintaining a balanced perspective, you can gain a significant edge in the Forex market. That's all for today's episode on FX Limit. Remember, knowledge is power, especially in the world of finance. Keep learning, keep trading, and I'll see you in the next video. Stay savvy, FX Limiters.